My name is Brian Davis with AccuPlan Benefit Services, and today I'm happy to have Scott Lefevre of Rockwell IRA be on the call with us to talk about TIC investments in your IRA or solo 401k. Scott will come on in about 15 to 20 minutes. He'll do his presentation, but first I'll get going. For everybody out there, just a little housekeeping. Everybody will be muted today except for Scott and myself. If anybody has any questions, there is a question box in the little screen there for you that GoToWebinar has provided, and there's also a chat box session which we can get to your questions, and we should have plenty of time to answer each and everybody's question. So without further ado, I'm going to get going. And in about 15 or 20 minutes, I'll be turning it over to Scott. So a little, there we go, starting to go. A little housekeeping before we get going. AccuPlan Benefit Services, we're not affiliated with any third parties or recommend any investments. We're not investment advisors. All information presented is for educational purposes only. Please contact any financial advisors, accountants, attorneys you might have before entering into any type of investments. A little bit about myself, Brian Davis. I'm the Director of Business Development for AccuPlan here. I have 3 websites you can check out: AccuPlanCalifornia.com, IRAwithCheckbookControl.com, and Solo401k.services. A little bit about myself. I come from a family in Northern California that is a rice farming family, and I grew up there, and at age 18 I moved down to Santa Barbara, California, where I went to school at UC Santa Barbara and graduated in 2001. Shortly after, beginning of 2002, I moved down to San Diego and got into doing real estate loans. I was doing real estate loans from 2002 through 2007, and then a funny thing happened. Market went a little haywire, and doing subprime loans for a builder division in San Diego all of a sudden went away very quickly. I kind of went around doing insurance and health insurance, life insurance products for a year or two before getting into the self-directed IRA space in 2009, and I've been in it ever since, and it's quite interesting. And in 2012, I was recruited over by AccuPlan to come and be the Director of Business Development for them, and it's been a great move for me so far. So a little bit about AccuPlan. We provide self-directed IRA and 401k administration and help people that want to invest in alternative assets. Now, AccuPlan is the marketing arm, and we have our own trust company out of Las Vegas called American Estate and Trust, and that's what allows us to be an IRA custodian. And I've been providing services for folks all over the country with a focus on California. But again, I'm not limited to any geographic region. So for those of you that don't know too much about self-directed IRAs, you're not alone. A lot of attorneys and CPAs that even I know, they have very little knowledge about this subject. And a lot of the reason for this is the IRAs came about from the ERISA Act that Congress passed in the early 1970s, basically saying you had to have a custodian to hold an IRA investment. Well, that industry has been dominated by the banks, investment banks, and insurance companies, which hold publicly traded assets, so stocks, bonds, mutual funds, ETFs, in the case of insurance companies, annuities. And there was a space left because in ERISA, it allowed you to hold a lot other investment types. You just had to have a custodian to do so. And that's the role we here at AccuPlan fill. I've updated this slide recently. It used to show that in 2010 there was about $4.7 trillion in IRA assets. Now that number is up at $7.2 trillion. And total retirement funds went from about $18 trillion to $24 trillion during that time. So as you see, the IRA and all retirement accounts have, rebounded nicely from everything that went on at the end of the 2000s there. And now there's about 5% that are in alternative investments, when back in 2010 the number was close to 2. So a lot more people are finding out that they're not limited to their investment options in the stock market. They can invest in things like real estate and notes, and which is what we're going to talk about today. So what we're seeing here, my screen's going a little haywire on me here, but these are the 4 asset classes we're mainly seeing here at AccuPlan. We're mainly seeing people invest in real estate, notes, and in private companies. And a lot of those private companies are invested in real estate. We also see those precious metals accounts sometimes as well, though that's not been my focus. My focus has mostly been real estate. But as you can see by this slide here, there's a million things you can invest your IRA in: raw land, oil and gas, lease options, promissory notes, mobile home parks. This list could go on and on and on. Going back, talking about the Congress passing the ERISA Act, they really only listed 2 things your IRA couldn't invest in. And those 2 things were life insurance contracts and what the IRS deems as a collectible. And this is a list here of some of the things the IRS deems as a collectible: work of art, metals or gems, anything illegal. And they've even made some exceptions to some of these coins, and there's certain precious metals coins that you can have in your IRA. You just have a custodian that will hold some of these other investments, which is what we do. Now, it's not just this simple, unfortunately. There is something outside of this called a prohibited transaction. So I'll try not to get too jargony on everybody, but a prohibited transaction is when your IRA gets involved with a disqualified person. And a disqualified person, if anybody wants to read further, can look at this in Internal Revenue Code 4975. So who's a disqualified person from you? You are yourself. You're a fiduciary of your account. There's no self-dealing in an IRA. You kind of need to keep these transactions at an arm's length. And you kind of want to think about these disqualified persons in a straight line up and down. So your parents, your grandparents, your kids and their spouses, grandkids, that straight line up and down. None of them can have any personal benefit from your IRA transaction. The transaction needs to be there to benefit your IRA and your IRA solely. So, and let's get into this a little bit further. If the IRS, who's the police of this, was to come in and look at your IRA and say you got into a prohibited transaction, they will disqualify that particular IRA from being tax deferred. And if you're in a pre-tax IRA, that could have some big tax consequences for you. So you kind of want to know what some of these rules are. So let's look at some examples. Hopefully everybody remembers this game show from NBC from about a decade ago, Deal or No Deal. But let's say you have an IRA and you want to lend yourself $10,000. Could you do that, deal or no deal? That one's pretty simple. That's no deal. That's self-dealing. That's a prohibited transaction. You would be dealing directly with yourself, a disqualified person. What about your brother? Could your IRA lend your brother $10,000? Deal or no deal? That one's deal. And side to side is okay. Now, you do want to watch out here. You can't just lend your brother $10,000 and have him reroute it to you or your company. The IRS will say, you know, indirectly, you're just skirting around these rules and we'll disqualify your IRA then. So you want to be careful. Make sure it's something unrelated to you that you're lending your brother money for. Now, what about your stepson? If you have a stepson, could you lend them $10,000? Deal or no deal? That one is also deal. If it was your son, it would be no deal. But according to the IRS and Department of Labor, stepson is going to be okay. And what about your daughter-in-law? Could you lend her money out of your IRA? Deal or no deal? That one's no deal. Again, your children and their spouses. So it can get kind of confusing. And if you have questions on your particular investment option, you know, that's where people like me can come in and help guide you. And if we don't know the answer to your questions, I can at least help, you know, put you to an attorney that might be able to help you with. But again, you need to know these rules. These are the main points to look at when deciding on a specific investment in your IRA. So let's look at some of the fun parts of this and not focus on that negative. How do we put money into a self-directed IRA? Well, self-directed IRA is really just a marketing term. that our industry uses, because we allow all allowable investments in your IRA. So we have traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, and even solo 401k plans for folks. And the difference with our products is it allows people to invest in all of those alternative investments. So if you have an existing IRA somewhere, we would do what's called a trustee-to-trustee transfer and transfer cash from that IRA over to your IRA with us, and that will allow you to have that extra control to invest in what you see fit. Or if you have an old employer plan, like an old 401k or 403b, you're going to want to contact them and do a direct rollover to your IRA with us. A frequently asked question I always get here, what about my current 401k with my current company? Can I roll that over to an IRA? And the answer to that is maybe. It depends if your plan allows what's called an in-service rollover, which means that plan allows you to move funds out of it while you're still in service. A lot of plans don't, but it never hurts to ask to see if this is what you want to do. And again, you're going to want to ask for an in-service rollover and have them do a direct rollover to your IRA with us. And the third and final way to put money into a retirement plan is through an annual contribution. Now, most folks out there are W-2 employees, and they might have a 401k at work, they might not, but they're only allowed really to invest or contribute to a Roth or traditional IRA. The contribution limits on that are $5,500 each, respectively. If you're over 50, there's a little bit of a catch-up contribution. You can throw in an extra $1,000 there. There's also a simple IRA, which is kind of like a 401k plan for a small business, where the employee can defer out of his pay up to $12,500. There's also a catch-up contribution there, and the employer can match that. That's a plan I rarely see. Sometimes I see people with old simples, and they just roll them over into traditional IRAs because they're also pre-tax IRAs like traditional, as opposed to a Roth IRA, which is an after-tax IRA. Now, two of the plans that I see for a lot of my self-employed clients are the SEP IRA and an individual 401k. The SEP IRA is a self-employed pension for the self-employed person and perhaps their employees, where that person can contribute up to perhaps 25% of their adjusted gross income to the plan, and the cap on that is $53,000 a year. So this plan allows that self-employed individual to help their retirement plan and by being able to contribute a bit more. That's a pre-tax contribution. There is no catch-up on the SEP IRA. And that leads us to the solo 401k or individual K, as some call it, where people can defer out of their pay. This is for that self-employed individual with no full-time W-2 employees. So they're both the employee and employer of the plan. So it's just like any company 401k, but it's just for themselves. And it doesn't matter if they're a sole proprietor or if they have decided to incorporate. An individual can defer out of their pay up to $18,000 a year, and then they can do what's called the profit sharing match as the company match, and they can match possibly up to 25% of their adjusted gross income, and the cap on that is $53,000. There is a catch-up contribution to the individual K. If you're over 50, you can throw in an extra $6,000 in the employee deferral section. We'll get into this in a second. A lot of people I talk to, they are active investors with their retirement funds. And they like to be able to get that money out quick and not have to go through the custodian and go through us each time for a transaction, even though we might take 2 to 3 business days. So for that, there's something called a checkbook IRA. And there's 2 popular methods that we're seeing with the checkbook IRA. There's an LLC method and a business trust method. Now, the LLC has been the more popular choice out there, most likely because in most states there's not a big fee, but in California, just having an LLC, that's going to run you $800 a year, plus there's also a gross receipts tax that could come in. So a lot of people, especially in California, have been moving towards a different entity structure called a business trust. Now, a business trust works very similar to an LLC because federally it's taxed as a partnership, just like an LLC. So if there's only one member, your IRA, it's what's called a disregarded entity or a pass-through entity, just like the LLC is. So you don't have to worry about filing a federal return, most likely. But the difference being, you don't need to pay the franchise tax board or do any gross receipts tax. And there's also an anonymity factor in the business trust that does provide you some anonymity because you are not going to file those articles of incorporation. But generally, most people just open up the IRA. They work on funding that account via those transfer, rollover, or contribution methods and direct us to fund the investment. And we generally take about 2 to 4 business days to do so. The difference, if you did the checkbook IRA, the investment would be into that entity, and then you would be able to do sub-investments into the investments of your choice. I want to get back to the self-directed 401k or the solo 401k. At AccuPlan, we call our product the 1K. And the 1K is a self-trusteed plan. You are the trustee of the plan. You are also the administrator of the plan as well as the plan participant. So what you can do, you can just open up a trust account at the bank of your choice and invest directly out of your own 401k plan. Other people will set up some type of business trust or other LLC then to do the investments, but you can go directly to the investment from the 401k plan. Now this doesn't matter, as I said earlier, if you're just 1099 or if you're an LLC or corporation, but we can help you with that if you haven't done it already. But you have the 401k plan. You can roll over other retirement dollars into it, start making those larger contributions, and invest directly into the plan. So the 1K allows you to also borrow money from the plan. There's a Roth option to the plan. There's a lot of benefits to the plan that make it a superior plan to an IRA. And if people have questions about this, please feel free to put it in the chat section or comment section or contact me afterwards. But with all of these plans, we allow you to invest in the alternative asset space. So being able to invest in real estate, trust deeds, private companies that do these types of investments, that's what we're here to help you do. And that's what I have for you today. I hope that was helpful. My name is, again, Brian Davis at accuplan.net is the best way to reach me, or call me at 619-432-4555 or check out one of my websites here. And with that, I'm going to turn it over to Scott. Scott, are you there?
I am here. Can everybody, well, can you hear me? That's right.
I can hear you now. So yeah, let me switch the screen over to you.
Okay, let me just hit that. Now, what are you seeing?
I'm seeing your desktop now, Scott, and now I'm seeing you bring over your PowerPoint.
There we go. Okay.
Well, thank you, Scott.
Right.
Today, I'm looking forward to your presentation. I got a little preview of it yesterday. So with that, Scott, I'll let you introduce yourself a little further and, take us away.
So I just want to double check, are you just seeing my presentation as it is now? No?
I'm seeing your presentation, and then I see the next slide coming up on the right.
Yeah, I don't know why that...
It still looks all right. Maybe hit that full screen one right to your right, too. That one. No, that wasn't it. Hit that again.
Yeah, I have never...
Yeah, it looks like you got the new version. This is fine. I think it looks fine.
Okay. Sorry about that. I've never seen that screen before in my life. So, again, thank you. Thank you, Brian, for that, and thanks for those who are on the call. I am Scott Lefevre. I'm managing partner and president of Rockwell IRA Real Estate Properties, and I'm here to talk today about tenants and common investments that I think, based on what Brian has shared with you, are perfect investments for the self-directed IRA and solo 401k product and industry. And that's what we're going to talk today about. I'm going to introduce you to tenants in common, a real quick introduction. Often tenants in common, if you'll see and if you understand, you'll see them tied to 1031 exchanges. I'm going to introduce that a bit and explain why, and then we'll talk about, again, why that makes a great investment for your self-directed IRA. Joint tenancy versus tenancy in common. There's some clarification that I think I'd like to make with the group, and that is we're not talking about joint tenancy. It's often confused with tenants in common. Joint tenancy, there's 4 unities of ownership that all have to happen at the same time. The acronym is PIT, P-I-T-T, possession, interest, time, and title. Again, a clarification as we go into tenants in common, but in joint tenancy, all owners have an equal right to possess that property. So these circles to the right, they're just giving you an even view of everybody that's involved. They each have that equal right. They all took that right at the same time on the same document, and they have equal ownership in the property. If one dies, and that's what the circles represent, there's a right of survivorship, meaning it doesn't go, that piece doesn't go to the heirs of the owner. It goes to the other surviving partners, and they then retain that equal ownership as it goes through. Tenants in common is the differences is that you can own a piece of that pizza or pie, we say, and it's an individual deeded interest, and there can be up to 35 owners in that pie with different sizes and different investments. They don't have to be equal. Owners do not have to take ownership at the same time. They hold their own title, and they can do with that title what they will. So they can sell that along the way. They don't have to, they're not tied to that, and if they pass away, or they can pass that on through their estate to their heirs. So the difference is more flexibility. You look at that, the government has said that you can, again, put in 35 owners. Often that can be unwieldy. That's a high number. And one of the things we tell you to look at is look at properties where there's less owners than that. Rockwell, again, this isn't a sales pitch, but we look at 10 to 15 owners because we want to make sure that that's manageable and doable in that area. So that is tenants in common. One of the history behind it is in the 1600s in England, it became possible to own land as a commoner, and these former serfs got together. They couldn't afford a good piece of land by themselves, so they got together and they joined forces, and they became tenants in common of that property. Today, fractional ownership, again, TIC or tenants in common, another word for that is fractional ownership, and that allows real estate investors, just like the former folks, to purchase an interest in something greater, maybe institutional grade real estate that they couldn't have had an opportunity to do individually. It gives them that opportunity to join forces. Back to the 1031 exchange note that I had made earlier. Why are 1031 exchanges and self-directed IRAs, why are they good investments there? Well, a 1031 exchange, if you know, is amount of money moved to defer capital gains. And so you're not having to find the exact building to meet the dollars. You can buy that piece of the pizza that fits your investment and have that flexibility in how much you want to purchase of that. So it's very attractive to people that have a set amount of money. They have to protect that amount of money against taxes, and they're going to roll that in. The same way with self-directed IRA. You don't have to go out and buy a property that's, say, matches the exact value. You have your value. You can go buy that share, that portion of whatever property is being offered in a TIC model. Also, you're not concentrating all your money or too much money in one property, which we preach diversification. So does Brian, and so do all good investment folks. And many times people are just tired of the burden of dealing with smaller investments or smaller income properties, rental homes, fixing them up, having to do what you have there, and they want some less management intensive investments. It's interesting when you get into self-directed IRAs, however, you can't touch, if it's a rental property anyway, like a home or an apartment or a duplex, what have you, multifamily home. Like Brian was saying, there's these disqualifying rules and that will have the IRS on you, and that is you cannot work on it and touch it yourself. You have to maintain an arm's length. You could have other people do that and pay them through the IRA funds to do that, but that's why these TIC properties can be, if it's the right property, an absolutely great investment, because you're limited, we're going to talk about that, to what you can do as a owner anyway, and who the tenant is, and what your daily involvement is, because you're not going to swing a hammer on the right TIC investment. You're not going to be tempted to put your own labor or put your wife or your son in the property. Those the ones that we're going to talk about protect you against that and just make it an easier hands-off kind of ownership. So TIC facts, they're not as liquid as stocks, bonds, and mutual funds. That's obvious. TIC is an interesting term that, just so you're aware, it doesn't mean the same thing to everybody. A timeshare is a TIC. Timeshare is also referred to as a fractional ownership or shared ownership. Those aren't particularly tax protection or driven for tax purposes. They just might be for enjoyment and vacation, and you can live in it and use it and benefit your family from that. Those are different. But once you get into one that is tax-driven and IRA protected, then we're talking about something else. We're not talking about timeshares. We're talking about owning that piece of the pie and having direct ownership, but then being a passive person to that transaction. I'll talk about also exit strategies on ownership in just a minute. The IRS Revenue Procedure 2002-22 was a IRS statement that talks about what's required both on a 1031 exchange for fractional ownership, and it applies also to self-directed IRAs. I'm not going to get deep into that, other than the key points that it talked about in that legislation is tenancy and common ownership, the number of limited owners that we talked about, voting rights, leasing agreements, proceeds, how they're shared, etc. So if you want to dig deeper into that, we can direct you that direction. But those same things apply for these investments. Another question that might come up in your research as you look at these is the statement about, is this real estate or is this a security? Just so you are clear, what we're talking about today is real estate. It is not a security. Rockwell doesn't deal in securities. We are an owner. So you as a purchaser or going to any owner, and again, you need to find that out and define that of what they're offering and what services they're providing. Because if you're pooling funds and you're going to manage the property and you have certain guarantees that are in there, these services that they call, then you become more of a security. So just find out when you're looking at the different properties whether it's considered real estate or security, because both have regulations behind them, and they're both correct ways to deal with it. It's just that there are differences, and you need to be clear. So again, the tail end of that discussion is multiple owners, tax deferred or tax free, just like any of the traditional, the Roth, the SEP, the simple, which you talked about. It does give you access to higher quality real estate. You have a prorated income based on your ownership, the appreciation, and all the tax benefits. You are an owner. You have a deeded interest and protected that way. And it is still an undivided ownership. You cannot force the sale of the building itself. You can force your share. You can sell your share of the pie and do with that what you wish. But it's not. You're not selling hallways and doorways. You're just selling a share of that ownership. This goes back to what I just talked about. A TIC sponsor can be a real estate TIC sponsor. That's what we are, or a securities TIC sponsor. Real estate sponsors can sell and do focus their efforts through CPAs, real estate brokers, professionals, and non-restricted advisors, independent advisors that aren't tied to broker dealers and other things because they have their own restrictions. They pay referral fees comparable to standards in the real estate world. They do not manage the property, and there are no collateral agreements between that sponsor and the TIC owners. Once that piece of property is sold to you as an investor, and you are part of a TIC agreement with the other investors, you are your own entity with that group. We or others can help you get a property manager, not to manage the property per se, but to deal with your paperwork, to send it to your self-directed IRA, your monthly income, your monthly rent check, and to do that at very minimal fees. These property managers might charge you $25 a month to deal with your paperwork and send you your check and do your tax statements at the end of the year. A TIC security sponsor is different, and they market through the network of broker dealers that I talked about. They can't take their commissions or fees. They manage the property. They also keep and retain the control of those exchange funds or whatever funds that's coming from through collateral agreements. So you're looking to them to manage that investment for you rather than buying that investment and being part of a broader group like the real estate side. So benefits of fractional investments: little to no management responsibility. We talked about investment grade properties at a fraction of the cost. Ease of diversification. We focus on non-debt properties. That's what got some TIC properties in trouble when the market dropped, is that they were highly leveraged. And so you look at that and see what you want. We focus on non-debt properties, and that doesn't mean that you can't go out and deal with your own slice of the pie with some non-recourse loans and lending. But just know that there's other restrictions and tax determinations by doing that you'd have to work through with your lawyer or your CPA. Look for the person, the sponsor that puts that together does the due diligence. They select the properties. They go out and kick the tires. They provide packages of due diligence to those investors, so you want to look for that. Those properties might be anywhere in the country or world. Again, you need to decide what you want to do and how you want to do it. We talked about prorated shares and capital gains and the requirements of whether it will fit. What we're talking about today clearly fits within all acceptable ranges of what you can put into a self-directed real estate IRA. The National Real Estate Association asked or put these questions together and said, why move to a TIC? 35% of real estate owners say they'd sell their investment properties to get rid of the management headache. Now, again, this is just all investors, so it's not saying it's self-directed IRA, because again, a lot of people will buy an investment property to work on it themselves. And so they might have even more headaches than the person that's an arm length away. but they're looking for cash flow investors seeking a passive investment and a desire to diversify. You can see right here the benefits, whether you're arm's length or not. The frustration and the fixing and the touching of various properties might not be for that investor. Some people want that, love it, do flip houses and put the right effort, even arm's length, into something, and that's fine. That's their direction. Other people might want a good, solid commercial building, single tenant building, triple net lease. The tenant pays all the fees and the property management, taxes, insurance. They send you a monthly check, or to your property management group. They divide it out by your prorated share. You get your monthly check. It goes into your self-directed IRA, and you're not touching that, and you are passive in that. That's what I'm talking about. Those people that do this with sound fundamental investment principles, they look at a variety of issues surrounding who that tenant is, what's their strength, what do they do they have a recession-proof business, and hopefully that is something that's attractive to you as you look to that. So it's a trade-off. You can pick where you want to play, and many people play on both sides of the both sides. So it's just, again, what your strategy is as an investor. Exit strategies. Normally, a lease, or in a triple net lease ownership of a building that we're talking about in a TIC property that's got a great tenant and some great long-term potential, is a long-term income appreciation investment. So if you're looking to, again, to flip a home, probably not what we're talking about in this meeting here. We're talking about an ownership in that bigger property with the foresight to say, I'm out there. Now, you always have the option to get out. In what we do, and probably what many people do, is in that TIC agreement that you've signed with those 10 or 15 other owners, you have a first right of refusal. They have a first right of refusal to buy you out if you want to sell it. So that offer is made within that group of owners. They might divide your part up into several pieces, and or one person might take your piece and buy that from you. And also, there is an organic kind of secondary market out there. In our world, we've done, upwards of 50 properties, 50 buildings with multiple hundred investors. And so if the property you're in doesn't produce a buyer for you, you could place that property out in a broader audience. And I would guess most people that you work with in that environment, TIC sponsors, would have a list of investors that they could market that property to, and hopefully turn that when you need to. They are low liquidity. If it's a security, there's limited resale ability. If it's real estate, you're free to sell it through a broker or on your own. You're not limited there. But most of the TIC sponsors, if they're real estate, could help you, again, put that on the market to sell it. And then the resale of the debt-free property is much easier than one that's attached to anything with leverage and having to qualify for a loan at the umbrella level. Now, again, you can go at your own level and look at that and look at the debt consequences of bringing that into a TIC ownership. Is it worth it? It all depends on the property and you and your strategy. The difference here is a duplex versus a TIC investment, and the difference further is in an income producing property on the left is that you have various expenses that the tenant on the right absorbs through their triple net leases, and you also have a percentage of occupancy for that lease period that is less when you're trying to move multiple tenants in and out of property. And so, for the right property, for the right investment, and if you're looking at all the sound fundamentals that are there, a TIC investment can produce a sizable difference in return on the same amount of dollars invested. That comes, again, primarily because they're covering the expenses, and they've got that figured out among themselves. So why triple net leases make sense? Stock market volatility. That's why you're on the phone probably, is you're interested in figuring a little bit about what alternative investments are. Who knows what the market will do? That's just the variable we all live with. We've seen it come, and we've seen it drop, and we've seen it grow, and it's just something that we don't know. Alternative investments offer greater diversification to reduce risk. Obviously, like Brian said, you can invest in what you're interested in, not just real estate, but other things. So just understand that. On this is a triple net lease, so hopefully you'll be invested and interested in real estate. As I said, limited liability to commit that prohibited transaction and keep a long-term investment going for great returns. We focus, and I counsel you to focus on, we're not focused on strip malls and rundown buildings with tenants that are come and go and don't have a business model. So when you look at TIC properties that make sense, do look at long-term leases, triple net, 10, 20-year leases with renewals to options to renew. Look at new buildings or newer buildings, modern buildings in the areas of the country and areas within those local markets that are growing, that look good, that have the market demographics to support what you're talking about. Look at the tenant quality. Do they have the corporate backing? Is there a corporate guarantee from headquarters that they'll cover the tenant in your building or the franchisee or whatever? What's their track record? How many properties do they have? Do they do this all the time? Are they recession proof? Medical customers, for instance. Do people still need medical help in a bad economy? Yes. So we look at that. You should look at that. What kind of tenants would weather the recession? Look at the sponsor. Look at who you're talking with, the TIC sponsor, and figure out their references and their history. And look at the options to exit. So those are all things that you need to look at to be a smart investor, to be an astute investor, and to make every bit of growth opportunity for the dollars invested. And then finally, just some words of wisdom. Be vigilant and responsible to those procedures and processes that we're talking about. The IRS, I think, has been known to want to trip anybody up. So just follow the process, and that's what you get with good counsel from attorneys and advisors. You can have professional custodians that are well rated. They cannot, again, recommend the actual investment to you. They can educate you on options out there through these type of events, but they are not going to push you one direction or another. Beware of that disqualified person, those prohibited transactions, and seek professional assistance from those who know the business. That is all I have, my friends. I appreciate your time. I appreciate your listening, and if you have any questions, you're welcome to contact me at that information there, or Brian, and he can address anything you have also. But Brian, I'll turn that back to you.
Yeah, no, thank you, Scott. You know, sinking in a little bit better for me today compared to, you know, kind of the quick version yesterday. There is a question here for you that somebody wrote. What are the, and you might have answered this, he wrote this early and then has left, actually. What are the worst things that can happen, if any? Are there any legal issues that can occur that puts the investment at risk? For example, withdrawal periods, fund closing, property issues, investors are moving funds, and who fills that monetary gap with the property/fund?
Okay, so basically, again, worst case, we like to look at worst case, and every investor should look at worst case. For my world, that's why I was talking about the leverage or debt-free property. But the worst case is if you get into that type of property and a tenant, and again, there's no guarantees in all investments and many investments, even though you can protect yourself up to the 99 percentile and do all you can, and that's what I'm asking people to do when they look at their investments. But for that percent that might, a tenant might go belly up, and if you're a debt-free property owner and you don't have debt staring you in the face, the worst case is you go vacant on the property and your income shuts off, but your debt, you're not paying off anything until you get a new tenant. So the worst case in that is you go along and somebody drops out of a rental property and you have to go get a new tenant, but you're not servicing any debt. I guess, general speaking, not just my world, but the world, is that's where people need to look closely at the debt portion of that, because they can go into a TIC property with debt. They can go in and again, there's non-recourse lenders and others that will look at and put money toward that and help you out there, but you owe them the debt payment every month. And so if that's not going to be able to be serviced, then they're going to go after what they can to get that back, or they own the pie that you just bought and they'll put it back on the market and try to sell it. So I don't know if I talked my way around that, but it just depends on the property and how you go into that, what structure you go into it, knowing that if you're servicing debt and something goes south, which things did in 2008 and beyond, a lot of people were underwater.
Okay. One other question just popped in. How are these different from Delaware statutory trusts?
I have no idea. That's an honest answer.
All right. Let me see. That's the same question. Any other frequently asked questions that you might get that maybe haven't been addressed here, Scott?
I think again, if you go to the debt question, those are frequently asked questions. I can sidestep that because I don't do it, but I would just take those questions right to an accountant that understands the debt, the passive, the active involvement, and the portion of taxes that you have to pay if you are leveraged in any portion of that, because it does make it a little bit more confusing. The worst case question is what it is, and that gets asked. The exit strategy question is somewhere along those same lines. The counsel would be to look for a property that fits your investment options. This allows you to get into a lot bigger investment options. You can see on that next slide, I didn't put it in the presentation, but I had it there because it's old data. But the TIC industry is a hard one to get a view on. I'm going to pull that up anyway. This was back 8 years ago, but these are the types of TICs, and I would expect that they haven't changed much from what you see here. But office buildings take up 50% of those type of properties. Apartments a quarter, and then everything else kind of thrown in there. I would expect that hasn't changed much. So, that's the type of property that people are putting their money in. That's what they want to do. Can you fill the building with another tenant, a single tenant, and not miss a beat, or you're going to you're going to have trouble filling that building. And
Right.
again, what kind of guarantees are there?
All right. We got one other question that just popped in. Are there any minimum investment amounts?
It's again depending on the TIC sponsor. I'll speak to my experience on self-directed IRA money. We look for 100,000 or more. Our 1031 exchange folks are averaging 400,000 or more. That's what they're putting in. Again, those two types of funds are very different. The amounts that are available to folks, but we're looking at 100,000 plus, and I would expect that most TIC institutional investment properties have a minimum very equivalent to that in that same area. Some might drop a hair from that, and others might even be at 150 or 200,000. So you get into a property where there's 10, 15 owners, and somebody has $1 million into a property, and somebody has 10,000. It's just the matchup is, hey, there's a minimum, and we've got to keep that.
And then looks like we got one last question. We'll wrap it up here. What are the typical returns, and what are the fees for the service?
Okay, and again, it's hard to say until I talk about Rockwell, and I'm trying to talk generals, but all fees or all.
Let's just say Rockwell.
Okay, Rockwell has no additional fees. So if you want to put $100,000 into a property, we'll show you the property, give you a due diligence package, and in that package gives you the monthly rates for the next 10, 20 years with graduated increases, and you would receive your prorated share of that. It gives you the cap rates, and the cap rates depend upon the tenant. The more solid, secure any investment is, and less risk is less return, but we have deals at 5.5% to 7.5% to 8%, depending on the tenant and their time in the business. We look for opportunities, obviously, I told you, to be recession-proof and consistent, and a national tenant with a corporate guarantee. So you're not, it has to be the right investment for you. If you're looking to double your money in 3 years, a Rockwell investment, TIC investment is not going to do that. If you're looking and you're the right age and an investor that says, I want consistent income coming into my IRA over the next 20 years, and I'm 50 years old, and a part of my portfolio is, hey, I'm gonna plan on this steady flow at 6.5 or 7.5%. Here it comes. That's what I want to go invest in. So there's no extra fees. There's no extra fees from our side.
All right. Well, that should about wrap it up. If anybody has any more questions, will you go back one more slide to your contact information?
Yep.
Make sure you contact Scott Lefevre at Rockwell IRA, and his contact information is there, or feel free to contact me at briandavis@accuplan.net. And from there, I'm going to stop the recording and thank everybody. Scott, thank you very much for coming on today and showing a different side of things, a different alternative investment for people.
Thank you. Thanks for the invitation, and everybody, thanks for your time. Appreciate it.
Yeah, thanks everybody for your time today, and have a great day.